Welcome to a new IFRS Insurance Service. It's an initiative of OG Education Limited. It's dedicated to providing complementary and supplementary education on International Financial Reporting Standards IFRS through a multiple choice question and answer approach. It is intended to make learning verification, mastery, or intellectual assurance fun. In this session, we shall be considering cumulative set 210 questions to which the answers are provided on IFRS 13. This is the standard on fair value measurement. Viewers and subscribers have 30 seconds to select or choose the answer to each question. The answers to the cumulative 10 questions are reviewed at the end of all the questions. Please enjoy it. Question number 11. A fair value assumes that transaction to sell the asset or transfer the liability takes place in the A. Principal market for the asset or liability. B. Most advantageous market for the asset or liability. C, A or B. D, A and B. E, market created by the seller or transferor. Some counts. Ten seconds gone. $20 seconds gone. Timer. Question number 12. The principal market for the same asset or liability is A. Not always the same for different entities. B. Always the same for different entities. C. Never the same for different entities. D. Not in existence. E. The same as the most advantageous markets. Some counts. $10 seconds gone. $20 seconds gone. Timer. Question number 13. An entity considers which of the following characteristics in pricing the asset at the measurement date? A. The condition of the asset. B. The location of the asset. C. Restrictions on the sale or use of the asset. D. A and B. E. All of the above. Some counts. $10 seconds gone. $20 seconds gone. Timer. Question number 14. To measure the fair value of an asset at the measurement date, an entity need to A. Not have access to the principal market. B. Not be bothered about the principal market. C. Not consider market participants. D. Not able to sell the particular asset in the market. E. Be able to sell the particular asset in the market. Some counts. $10 seconds gone. $20 seconds gone. Timer. Question number 15. The valuation technique that reflects the amount that will be required to replace the service capacity of an asset is called A. Income approach. B. Cost approach. C. Market approach. D. Present value approach. E. Current value approach. Some counts. $10 seconds gone. 20 seconds done. Time up. Question number 16. The valuation output that uses prices and other relevant information generated by market transactions involving identical assets, liabilities, or business is the A, income approach, B, present value approach, C, current value approach, D, market approach, E, cost approach. Some counts. 10 seconds gone. 20 seconds gone. Timer. Question number 17. The price that will be received to sell an asset or pay to transfer a liability is called A, exit price, B, entry price, C, market price, D, fair value, E, transaction cost. And counts. 10 seconds gone. 20 seconds gone. Time up. Question number 18. The price paid to acquire an asset or receive to assume a liability in an exit transaction is called A, exit price, B, entry price, C, market price, D, fair value, E, transaction cost. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 19. The risk that an entity will not fulfill its obligation is called A, credit risk, B, liquidity risk, C, non-performance risk, D, market risk, E, default risk. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 20. Compensation sought by risk-averse market participants for bearing the uncertainty inherent in the cash flows of an asset or a liability is referred to as A, return, B, market reward, C, indemnity, D, risk premium, E, interest. And counts. 10 seconds gone. 20 seconds gone. Timer. We proceed to review the answers. Question number 11. The answer to question number 11 is C, A, or B. C, A, or B. A fair value measurement assumes that the transaction to sell the asset or transfer the liability takes place either 1, in the principal market for the asset or liability, or 2, in the most advantageous market for the asset or liability in the absence of a principal market. It is on either of these conditions, but not both. C is the answer to question 11. Question number 12. The answer to question number 12 is A, not always the same for different entities. A, not always the same for different entities. The principal market for the same asset or liability is not always the same for different entities. As different entities with different activities may have access to different markets, the principal market for the same asset or liability might be different for different entities. A is the answer to question number 12. Question number 13. The answer to question number 13 is E, all of the above. E, all of the above. When measuring the fair value of an asset, an entity considers the characteristics that market participants would consider. The characteristics are 1, the condition of the asset, B, the location of the asset, and 3, restrictions on the sale or use of the asset. E is the answer to question number 13. Question number 14. The answer to question number 14 is D, not able to sell the particular asset in the market. D, not be able to sell the particular asset in the market. Out of all the options, the only one that holds is that of option D. All of those do not stand under IFRS 13 fair value measurement. To measure the fair value of an asset at the measurement date, an entity need not be able to sell the particular asset in the market. While it needs to have access to principal markets and needs to consider market participants, it does not need to actually sell the asset in the market to measure the fair value. D is the answer to question number 14. Question number 15. The answer to question number 15 is B, cast approach. B, cast approach. Cast approach is the valuation technique that reflects the amount that will be required to replace the service capacity of an asset. It is also called current replacement cast. B is the answer to question number 15. Question number 16. The answer to question number 16 is D, market approach. D, market approach. Market approach is the valuation approach that uses prices and other relevant information generated by market transactions involving identical or comparable or similar assets, liabilities, or a group of assets and liabilities, such as a business. D is the answer to question number 16. Question number 17. The answer to question number 17 is A, exit price. A, exit price. Exit price is the price that will be received to sell an asset or paid to transfer a liability. A is the answer to question number 17. Question number 18. The answer to question number 18 is B, entry price. B, entry price. Entry price is the price paid to acquire an asset or received to assume a liability in an exchange transaction. B is the answer to question number 18. Question number 19. The answer to question number 19 is C, non-performance risk. C, non-performance risk. Non-performance risk is the risk that an entity will not fulfill an obligation. C is the answer to question number 19. Question number 20. The answer to question number 20 is D, risk premium. D, risk premium. Risk premium is the compensation sought by risk-averse market participants for bearing the uncertainty inherent in the cash flows of an asset or a liability. D is the answer to question number 20. That is all for this set 2. Thank you for joining us for the set 2 of IFRS 13, Fair Value Measurement. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all those subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of questions and answers on standards already covered. For collaboration in this area, please call or WhatsApp +2349 030 770109. All rights to this production and others in the series are reserved for OJ Inspiration Limited. Thank you once again, and bye for now.